Okay, just a few hours ago, I posted a trade here on the dollar Canadian. This is the dollar Canadian. We're looking at a 5 minute chart. I'm going to go back and forth between the 5 minute chart, the 1 hour chart, just so that I can show you different things. Just as a quick reminder, I'll go to the 1 hour chart and show you what I was talking about in the previous video this morning. So the previous video, we were talking about this breakdown right here. I was talking about how the comparison between something that somebody had posted on one Facebook group. They were talking about resistance 1, resistance 2, resistance 3. They were expecting it to move back down, bounce back up, hit this area right here, and then they were going to short it, which caused a lot of people that were trying to trade off of this person's recommendation. I don't know the individual. I don't know who that person is. It was just brought to my attention. And somebody had sent me an email and said, I tried taking this trade and now I get what you mean, because I say this quite a bit, which is to be really careful about learning for free on social media, right? You start following some of these people and you start thinking that they know what they're talking about because their charts look pretty fancy. They look like they're drawn up and marked up like from somebody who knows their stuff. But you have no idea who that person is and how much experience they really, really have. Like everybody can say that they've been trading for a long time, but have people really been trading for like, 20 years, or in my case 22 years, or 30 or 40 years? And some people will say that they have been trading for about 15 years. Be careful is what I'm trying to say. So anyway, a lot of people were trying to buy when price was right down here, and we weren't expecting that. If you follow this Wyckoffean principles and the principles of accumulation and distribution, you would have known that this was likely to turn around and just kind of drop right down like this, and these would be your normal targets. So again, this morning's trades, we were entering the dollar Canadian to the downside at 1.2561, and it ended up hitting ultimately a target here at 80, the psychological level of 80, 1.2480. And that's sort of where I stopped and where I was done with the trade, and that's what we were talking about in today's video. Now, everything that you see right here, the way it reversed and it came right back up again, I wasn't expecting that. I was expecting that it was going to stay down here in a relatively tight range of consolidation after a pretty dramatic move. It doesn't mean that it won't happen. So it wasn't like I got caught off guard. It's just that typically price will move sideways. And now I'm going to go to the 5 minute chart so you can see what we did here. And you can see, let's go ahead and tighten it up one more time. So you can see here, this was after the target of 1.2480 to the downside. And then at that point, I expected that this is what it was going to look like. Unless something happens, and this is why we never really know, but we have to stay prepared and alert, and that's why we continue to go back and forth between the 1 hour chart and the 5 minute chart to find these areas of accumulation and distribution. Is it possible? Well, what would cause this move and this reversal? Well, we know that the dollar Canadian is a pair that we refer to as commodity currency. It's one of those commodity currencies. And if there's something big going on in the commodities markets, specifically oil, it could cause a reaction where we would get a trading opportunity on this one. So let me show you what oil looks like. Oil topped out for the day and then reversed just about the same time that all of this was happening. So there was a direct correlation here between, again, this commodity currency, the dollar Canadian, with oil. We had our preliminary support. We had our buying climax, which was right here when we got out of the trade to the downside. And then we find our automatic reaction. So at this point, we draw our levels out from the buying climax to the automatic reaction. Here we had what is very, very typical in this accumulation schematic, where it moves up and then we wait for the spring. We don't know if we're always going to get the spring. We wait for it. Sometimes we don't get a spring. And if we don't get a spring and we get tests of support right here, then the only time I would get into, and I say this all the time, if it was schematic number 2 where we did not see a spring, where it exceeded that buying climax low and it only tested the buying climax low and again did not exceed the buying climax low, if it didn't do that and then it moved up, I wouldn't get in here. I would wait until it broke out above the automatic reaction high, which is resistance, and then wait for the pullback and then the bounce. So it would look like that breakout, pullback, then bounce. That's what I would be waiting for. And that would be the safest entry. But that's not what happened here. What happened was waiting for it and waiting for it and waiting for it. I can see that these highs are getting lower and lower. I drew a trend line, and you don't know which one is going to actually be the high. You have to move it around a little bit. It's sort of a testing where you're drawing it across several different highs to see which one is actually going to produce the best results. At some point, though, I'm going to have a couple of different lines that look like this, right? It's going to look just like this. This is what it's going to look like initially. But I'm still waiting. That's not what's getting me into the trade, is these downtrend lines. It's just to draw to my attention that these moves to the upside are getting weaker and weaker. So if it's going to create a dramatic explosive move to the upside, something significant has to happen, which is right here where it actually breaks through support and then pulls back and creates the spring. Well, here's the spring right here on the 5-minute chart. Here's the test. Here's where it jumps back up above the buying climax and back inside of this range of consolidation. And then here we have the test. We have another test. This is a more significant test that holds. And then it starts to run into that downward trend line. Again, the downward trend line in the breakout is not what's putting me into the trade. A lot of other traders will use a break of the trend line to put them into the trade. And that's where you start to run into problems, where you're just using the trend line and not understanding the structure of this distribution or accumulation. In this case, it's accumulation. We're expecting a really significant move down here. So again, another test right here inside of accumulation, inside of this range of consolidation, above the buying climax low. And you can see how the whole thing plays out. And here's where it actually starts to break out and above. So there were a couple of areas after getting a significant spring to get into the trade if I wanted to do that. Well, I'm more conservative, right? I probably wouldn't jump in here when it's holding below that buying climax low, because to me it still looks like more pressure to the downside. Here it significantly not only breaks above this little trend line. Again, the trend line's not putting me into the trade. It's just showing me where the shift in momentum is starting to occur. So here it breaks through, pulls back. This is where I would get into the trade, because now I'm getting a pullback in bullish engulfing candles or bullish engulfing bars that are holding above the buying climax low inside of this range of consolidation after a test. So I can see that. And I'm also counting the waves here on the 5-minute chart with my volume indicator. And then here is also a second entry opportunity where it breaks out and up and pulls back, tests and holds, and then gives me a bullish, let's say you wanted to use a bullish engulfing bar, so, or a candle. So my entry here to the upside was 1.2509. First target is 20, second target is 50, and here would be the final target if it keeps moving higher, 80. I'm using psychological levels as my target to get out of this trade. Let's take a quick look at oil. All right, so now we're looking at the oil. So oil, this is a 5-minute chart. You can see how it rallied up this morning, stopped, reversed. So this would be an interesting homework, right? Print a screenshot of this and then mark up this chart, and you'll be able to see the breakdown, how we were able to trade the dollar Canadian. So when weakness occurs in the oil markets, we could typically, not all the time, not every time, don't look for it like every single time like that, because sometimes the dollar Canadian will react to economic data for Canada. But today, there was a pretty significant move. I mean, we went from 105.12 or 105.10 all the way down here to 102.30 or 102.50. So that's pretty significant. Quite a reversal all the way back down here to pretty much where it started. Now, again, so I was saying that very often when you see some kind of behavior like this, you can see, or you'll see a reaction. If there's weakness here in this market, oil, we would expect some Canadian weakness, which means that the dollar Canadian pair would rally to the upside. When we see it moving here upward in this market, this is oil, it's moving to the upside, you'll notice that the dollar Canadian was moving to the downside. That's dollar strength. Canadian strength typically is going to move in the opposite direction. So that provided the opportunity this morning for us to trade that in addition to the economic data to the downside. So these support very often, and they sort of coincide with the commodities markets, you'll notice at times, along with the economic data out of Canada.